Welcome to Real Estate Radio Power Investing, an informative and engaging hour discussing everything you need to know about the world of real estate investing. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate Radio Power Investing, Tom K. Wilson.
So nice to have you with us today, and thank you for tuning in to our Real Estate Radio Power Investing program, where we empower you with the education to maximize your investing success. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220 AM, the Wall Street Business Network. I'm Tom K. Wilson, your host for this weekly program on real estate investing. If you can't make the live show, you can catch our podcast on TomWilsonProperties.com or on iTunes or on YouTube. Go to TomWilsonProperties.com to sign up for our weekly newsletter. Also gives you access to syndication commercial opportunities that are only available to our client base. Also gives you a weekly newsletter on economics that are going on in the country about real estate. And also we look forward to any of your questions that you have for us or suggestions for future topics and future guests. So we today have a program on the private placement syndications titled Increase Your Success with Private Placement Securities. And we have with us today Mauricio Raud, whom I've had the pleasure of knowing for a number of years. He's an attorney who is an expert in asset protection and private placement memorandums. He's undergrad from UC Berkeley, and he's got a law degree from Loyola Law School. And he's often a speaker, and he's known for being a anti-lawyer, in that he's a practical attorney who gives very practical information and leadership in your and whatever legal aspects that you need in the asset protection and private placement arena. And we are very glad to have him on the program. Welcome, Mauricio.
Thanks for having me, Tom. Appreciate it.
Mauricio, we've tell us a little bit about when you got out of school. What guided you toward this specialty of private placement securities and asset protection over all the other things that you could have done?
Yeah, so after I graduated from, I went to Cal Berkeley, so a shout out to all my Bear fans out there, and Loyola Law School. I did what basically all lawyers dream of doing. I went and joined a pretty successful law firm down in Southern California, and I specialized primarily in securities laws and maritime, believe it or not. But really, I was a litigator. So my job was to defend people, in court. So I was answering complaints, doing depositions, motions, trials, arbitrations, you name it. But pretty early on, I recognized that there was no way I wanted that lifestyle for the rest of my life. I was having that issue where I'd get up in the morning and I would go to work and I would, work all day. I'd come home. I'd eat something, watch a little TV, and go to bed, and have to do it all over again. And I'm sure a lot of your listeners can relate to that. And even going into work on the weekends, and I'd see partners that have been there for 20, 30 years, clocking in at 7 a.m. on a Sunday. And I said, this is just not the lifestyle for me. So I pretty early on recognized I didn't want to do that type of lifestyle. And fortunately for me, I got connected with a couple of great people that I know you've had on the show before, Tom. One of them was Robert Kiyosaki, obviously, and then the Real Estate Guys. And it was really when I joined, I actually went to work for the Real Estate Guys in their development company. I was their in-house counsel for many years. And that's really when I started doing all of their syndications. And that's really how I transitioned kind of away from what I was doing before in the litigation world. I started doing all of these equity raises for Robert and Russ and in-house. Who knows how many of those I did back then. And then after a while, I just kind of decided I could start my own firm, and I did that now just over 10 years ago. Started my own firm, and obviously continued to have Robert and Russ as my clients. In fact, I'm Robert's personal attorney. But now I've just expanded that, and I'm obviously helping many people raise capital Since I've started my own firm, I've raised over $100 million in capital for investors, and most of them are mom and pops. Most of them are people who are in the real estate space, and what they're looking for is to expand their real estate empire. They've run out of their own money, and so it's time to go find bigger deals with other people's money. And that's kind of how I transitioned away from the litigation world and moved over to really helping people raise capital on the front end.
And of course, I've seen you with these folks a lot, and it must also be really nice to not just be one more component of a big wheel, but actually be part of a team that's got a direction and goal, and you get to stay with them and work with them and carry the knowledge of those team members with you and help them continue to have success.
Yeah, and that's critical. I mean, as you know, Tom, a syndication is a team sport, and so I have my role, but it's one of many roles that a syndicator has to put together. But yeah, working with all these brilliant minds and watching people put together their syndications and really the excitement that I see in their eyes when they discover syndication and they're doing their first one. And I deal with a lot of first-time syndicators, and it's really rewarding to help them through the process and help them get to do their first syndication.
This is the most exciting thing I've done in a number of years, and I've always been excited about real estate. And I, had done a few JVs and syndication participation years ago, but here recently, the last 3 years, we decided to make it more of a major business unit for Wilson Investment Properties, and it has just taken off. And I just feel so good about providing some passive investment opportunities to other folks that I have high confidence is going to contribute to their financial success and future.
Yeah, and that's one of the nice things about syndication, Tom, is that from a financial standpoint, there really is, and this is something that a lot of people have a hard time getting their minds around, but there really is an unlimited amount of money out there. What's lacking is deals, right? So there's way more money than there are deals. And so once you can get your mind around that concept and just bring value to people and find a good deal and show them how they can turn their hard-earned cash into some passive income, that's, I think, in my mind, one of the keys to being a successful syndicator.
I think one of the most valuable things that we bring to investors is something they never see, and that is all the hundreds of hours in deal flow that we look at and try to vet, and it's not good enough, and we reject it. So we reject a lot of stuff and spend literally the team hundreds of hours using many decades of experience. So the ones that make it through the funnel and get presented are the ones that have really passed a really tough test and tough filtering.
Absolutely.
Let's tell our listeners who don't know about it what is a syndication. What makes it different? What's the private versus public security? Talk about that a little bit, if you will.
Yeah. So a syndication is a pretty simple concept. It essentially involves somebody, and usually it's the sponsor or the promoter, but somebody collecting money from third parties and doing that work of bringing in that capital in order to do a specific deal. And it doesn't necessarily have to be a huge thing. You could literally have a two-person deal where, hey, I bring in the money or find the money and I do all the work and get the deal done. You can have a two-person syndication. But anytime you are receiving money from other investors, and you're responsible for creating that return, then that is essentially a syndication. And once that happens, once you enter that world of syndication, which is essentially secured, once you enter in that world, now you're subjected to all of the beautiful securities laws that are out there, which is where I come into play and making sure that world is navigated without stepping on too many landmines.
And I treat the SEC regulations very, very seriously to keep both my clients and myself out of trouble with help from folks like you, but I treat them as even more serious than any real estate board or IRS. SEC is a pretty ominous set of regulations, isn't it? That's should be taken very seriously.
They should be taken very seriously, and not only the SEC, which is the federal level, but also the state. So you've also got to pay attention to the states that you are selling into or looking for capital. You want to make sure that you're complying with with those laws and making sure you're, to the extent you've got to be doing some filings in that state, that somebody's taking a look at that. And
most, if not all, states will allow the federal SEC regs to override as long as you file properly. That correct?
Yeah. So yes, and it depends on the exemption. So what I tell people, just kind of really high level, Tom, is when you're dealing with securities laws or dealing with a syndication, there's really only three things that you need to worry about, three things that you need to consider. One is you have to register that syndication with the SEC. That's option one. Option two is you have to find an exemption to registration. Or number three, it's illegal. It's really that simple. Mm-hmm. Register, find an exemption, or it's illegal. Mm-hmm. And so the registration part we avoid almost at all costs because it takes so long to get through the federal government's red tape and bureaucracy that you'll end up getting stuck there for a couple of years and spending 6 or 7 figures. And as you know, Tom, we don't really have that kind of time when we put an offer into a property. We don't have 2 years to wait around for the government to approve our deal.
And from a Silicon Valley perspective, that's what most people know as a initial public offering, where it costs hundreds of thousands of dollars and takes many months to get that ready to offer a stock to the public, right?
Absolutely, and if not more. Sometimes I've got a couple clients who have done it for 7 figures, so it's a lot of attorney fees. I also assume I expect that most people don't want to do an illegal offering. And when I say illegal, I'm not talking Bernie Madoff type illegal. We're not talking about somebody intentionally defrauding investors to get money, but even little things that you don't even think about in terms of maybe exaggerating some of the returns or not fully disclosing some of the things that you're supposed to disclose. That could end up being an illegal offering, which will land you in hot water. And so what we typically look for, and that's what my practice focuses on, is finding that particular exemption that will allow us not to do a registration with the SEC, but still be within the confines of the law and make sure we're doing it legally.
Mm-hmm. Okay. And the SEC was formed, about 1933, was it, to regulate the securities?
The 1933 is the Securities Act. So after we had that the Great Depression and all that disaster happening with the stock market, they passed the Securities Act of 1933 and also then 1934, and that's where a lot of the regulations started way back when. And that's what we rely on now. And obviously, over the years, there've been more and more addendums and revisions, and primarily there have been some new exemptions that have come on board here in the last few years that have really made raising capital much easier because it's just expanded your network.
Okay. We have Mauricio Raud here, a longtime attorney and expert in asset protection and private placement memorandums and securities, with us today, trying to take some of the mystique out of what these private securities are all about and how you can participate as either a syndicator or as an investor. So we'll get back in a moment and talk some more with Mauricio about the securities, private placement securities. Stay with us.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Yeah, with us today, Mauricio Raud, and he's an expert in securities, and we're talking about the difference between private and public securities. And in the private arena, if you're a syndicator where you're taking other people's money and promising or projecting returns, we should never promise, right? And
definitely don't guarantee anything. I'll tell you that.
Yeah. So let's talk a little bit about. All right, if you're going to avoid spending hundreds of thousands of dollars in months to try to take something to public, and you're going to do a private offering. We look for a regulation, an exception regulation, which is under Reg D. So let's talk about that a little bit.
Yeah, so there's actually quite a few different exemptions that we can rely on, but most people end up falling into what you just referenced, what's called a Reg D, a Regulation D as in David, a Reg D exemption. About 95% of all syndications are done under Reg D, and there's a couple of reasons for that. The main one is, and it's something you alluded to earlier, once you are able to fit within this exemption, this Reg D exemption, then you are preempted from having to, or not preempted, the federal law preempts the state law. And so you don't have to worry too much. You still have to worry some, but you don't have to worry too much about the individual states. So once you comply with this Reg D, and we'll talk about a couple specific ones, but once you comply with Reg D, then all you really need to do at the state level is file a notice requirement with them. Just let them know, hey, I just raised a bunch of money and here's some statistics. But there's no actual registration or exemption process. So there's no need to hire an attorney in that particular state. And so that's very attractive. You deal with one attorney, one federal statute. You don't have to worry about the individual things. And then the other reason is that it provides a safe harbor, especially the rules that we're going to talk about provide safe harbors, which means, hey, if you hit these 5, 6, 7 elements of this exemption, then you are assured that you are in compliance with the securities laws. There's no guessing. There's no, hey, it's a subjective test. If you hit these 5 or 6 things that we'll talk about, then you are able to use that exemption and not have to register with the SEC, which makes everyone's life a lot easier.
Okay. So let's get a little bit more granular here and talk about these.
Yeah, so fortunately for us, the exemption that we typically rely on, which is a Rule 506, and that's about as granular as I think we should get with this. But in Rule 506, the nice thing about 506 is that it allows you to raise an unlimited amount of money. So that's a very attractive thing.
I like that. I like that part.
Yeah. There's a lot of other regulations that may or may help you, but they have limits. You can only raise $1 million. You can only raise certain things. So that's an attractive thing. You're allowed to take, in one particular one, which we'll talk about, you're allowed to take some non-accredited investors. That means people who are, do not have over $1 million in net worth, excluding the residents, or don't earn a couple $100,000 a year. You're allowed to take up to 35 of those. However, if you decide to take non-accredited, then there is one important prohibition that you have when looking at this exemption, and that is you cannot advertise or solicit your investment. So you have to offer this to people that are already in your sphere of influence, that they're either friends, family, workers. Somehow you've connected with these people prior to making this offering. So you have to have, the general rule is you have to have sort of a pre-existing relationship with your investor in order to rely on this exemption that allows you to accept non-accredited investors.
And the SEC does not define what that relationship is, does it? But there's kind of an industry standard, right, on standard practices.
Yeah, that's where you start getting into, I don't want to say gray areas, but it's interpretations, like what constitutes a general solicitation, what constitutes advertising, what constitutes having a pre-existing relationship, and that's where you want to have some good counsel to be advising you in your specific facts and circumstances to make sure that that you're doing it properly, stepping over that line.
Mm-hmm. Okay, and so it divides between 506B and C, and historically most of it's been 506B, which means that you have to stick to the non-advertising, non-soliciting approach. And then the 506C was relatively new, that now does allow you to go into general solicitation, but has some restrictions on it. So when we come back from the next break, let's talk about that just a little bit before we get into some other areas. So we have Mauricio Rauda with us today, who's a attorney who's an expert in private placement memorandums and syndications and securities law here on Real Estate Radio Power Investing on KDOW 1220 AM, the Wall Street Business Network. And we're going to be asking him about where we think things are going. We're talking about with securities, about regulated crowdfunding, which has been the popular crowdfunding term, and things like that. Stay with us. We'll be right back.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Mauricio Rauda with us today, a securities and private placement expert. So, Mauricio, and 506C just became into law when? 13?
Yeah, September 2013, September 21st, I think, 2013. And so before then, just to kind of recap real quick, but before then, we could raise an unlimited amount of money. We could take up to 35 non-accredited investors, but we could not advertise and we could not solicit. And that was our big limitation. So part of this Jobs Act that passed during President Obama's tenure in 2012, one of those rules which became effective in 2013 was a new exemption, or sort of a split of exemption, which is the 506C, to be differentiated from 506B, which is what we initially talked about. And 506C did something really interesting and really great for sponsors, and that lifted the prohibition against advertising and solicit. So as of September 2013, if you wanted to put your syndication, you wanted to take out an ad in the Super Bowl, you could do that. If you wanted to go on a radio show and pitch your deal, or talk to people you've never met before, go to trade shows, do whatever you want, that was now allowed. The only limitations now as a result of that lifting of prohibition is, number one, you could only accept accredited investors. And that was the first limitation. So no non-accredited. And number two, you had to take what's called reasonable steps to verify that these investors were accredited. You were no longer able to, at least under this exemption, rely on your investors' representation. So in the old days, we would simply do a questionnaire and they would check the box and say, yes, I'm accredited because I earn a lot of money or I have a lot of assets. But under 506C, you have a requirement now to take additional steps. And there's some safe harbor provisions in terms of, look, if you look at, obviously, if somebody's claiming that they're making more than $200,000, then clearly if you got a W-2 stub or looked at their tax, page one of their tax returns, there's those kind of 1099s. Those are ways to verify that they are making the $200,000. Or in the event that they're relying on the $1 million exemption as an accredited, then you want to look at their asset sheets and, appraisals of their properties and a credit report to make sure that we don't, understand what liabilities they have. So you really had to do some digging to confirm that. And what's really come out of that really is, especially when you're dealing with people you don't know, it's very difficult to ask for these types of information from somebody you just met at a trade show, or somebody called you after being on a radio show or something like that. And so there's a lot of third-party verification companies that have sprouted from this that will actually do the verification for you, which makes life a lot easier for you because, number one, you don't have to deal with that compliance nightmare. But number two, it gives your investor that you may not have a really great relationship with, or it's a new relationship, gives them a little bit of comfort that they're not going to be providing their financials to you. They're simply giving it to a third party who will review it, will confirm you're accredited, and then just let you know that they've done the research and confirm that they are indeed accredited investors. And
that's what we tend to do at Wilson Investment Properties. We have third-party outfits that handle that, and they do that quite well. It's a little bit of a hassle, get a little bit of pushback from folks just because it's more paperwork. I think it's more of that than anything else, right?
Yep, and it's not a huge deal. It's actually really inexpensive. I mean, that's what I told that the amount of work that goes into it. It's just easier to pay $50 or $100 per investor to a company, and they'll do all the work for you. Yeah, and we cover that cost for our investors. So we don't want to put that burden on them. So that works out. And real quick, Tom, sometimes it's as easy as getting a letter from your CPA, right? If the investor can provide a CPA letter, then that'll cut it. So sometimes it's not even that difficult to do. Yep, and we do that at times, and that works too. And so you're limited to accredited investors, and they can't just check the box and say we are one. You have to do some vetting. So we find in our client base we maybe lose about 25% of our clients when we do a 506C, but it's not that's not too bad. So most of ours we do 506B and occasionally 506C, and not too many people are doing C's yet. So we'll talk a little bit more about securities and private placement investing when we come back here with Mauricio Rao.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Mauricio, one more thing I want to ask you about the 506B is for the non-accredited investors. there's really no dollar limit on that, right? They just need to have we really need to acknowledge that they have a good understanding of finance and investing.
Yep, no dollar limitation. I tend to recommend if you're going to take money from a non-accredited, you obviously don't want to take 90% of their net worth, right,
yep,
or 80% of their net worth. So you want to it's a good practice, but there's certainly no law that prohibits that. But I tend to recommend that for clients. But they can raise an unlimited amount of money from because sometimes you're actually in a non-accredited, but you may have a lot of money. It just may be a weird situation. And so if the non-accredited investor wants to put in $800,000, there's no limitation to that.
Now, a private placement memorandum is what you're required to give to non-accredited investors. It gives all the disclosures, but in actuality, you recommend having a private placement memorandum that you give to everybody, whether you're accredited or non-accredited. Is that correct?
Yeah, that's my practice. I mean, legally, as you mentioned, if you're only dealing with accredited investors, there's no legal requirement to provide them with a PPM, a private placement memorandum. And just real quick, a PPM essentially where you just lay out all of the disclosures, all the possible ways your investment go wrong. It's really a very detailed disclosure document. It's almost kind of a little bit of a scary document. I always joke with people that your project, your business plan needs to be so good that you have to overcome when they actually get your PPM, because that's where you're going to talk about how everything can go wrong. But in my view, so that's not necessarily required for an accredited investor. It's required for non-accredited, primarily to protect the non-accredited. But in my view, it's kind of a double-edged sword, but in a good way, meaning if you provide a private placement memorandum, it also provides you with some protection as the sponsor, because now even if they're accredited and they come back and say, well, I didn't know this or I didn't know that, you can point to your PPM and say, hey, look, it's all in this document. I disclosed every single fact that was material. So, how can you claim that you didn't know X, Y, Z when it's right here in the document? So I tend to err on the side of doing a PPM for both accredited and non-accredited investors.
And based on your advice, Wilson Investment Properties indeed does that. We give a PPM for everyone, and we don't take money until after that PPM is available. In fact, that's how they have to sign up, right? They have to sign the subscription agreement and purchaser questionnaire section of it, and state that they've read it and understand it before you can take their money.
Absolutely.
Yep. And so a good PPM, in addition to having the SEC disclosure in there, it should also in your mind, do what? Just show show everything that the syndicator knows about that property and product and its returns and all the where all the money comes from and where is it going to be used and so forth, right?
Yep, and everything because your business plan is part of your PPM. So your business plan obviously is going to talk about what you're planning on doing with the money, where it's going, what the uses of those funds will be, what the projections are looking like, information about the team, your experience, your track record, basically trying to convince the investor why this is a great investment. So it's all encompassing. PPMs also include, as you mentioned, a subscription agreement, which is the actual document where they're subscribing into the deal. Operating agreements or partnership agreements, depending on what kind of entity you're using, that would be in a PPM. And of course, the questionnaire, the investor questionnaire that tells me, are you accredited or not accredited, would be part of that PPM. So it's pretty much, it's a long document. I get a lot of flack sometimes from my clients that I hand them over a PPM with all those documents, and it's 100, 150 pages long, and it cures insomnia for sure.
Yeah, indeed. But on the other hand, it sounds complex, but it's a lot of it's the SEC disclosures that there's risk involved and so forth. But it's also a great business plan. I ask people, how many times have you bought a public stock or any other investment firm, and you've had this much information available to you to help evaluate if this is a good match for you? So I think from that standpoint, it's an outstanding way to invest, because you really, if you want to know the information, there it is. There's a good syndicator is going to show everything they know about it and give you the comfort that you need, that they've done their due diligence. Right?
Yep, I mean, and it's really, I always like to give the example from stage where, I had oral surgery not too long ago, and every time you go in for oral surgery or any type of procedure, they hand you that medical consent form, right? All the ways things could go wrong. You could die from getting your tooth pulled.
Yep.
Yeah, maybe, but, the odds are 1 in a million. So that's really kind of the analogy I like to do with the PPM. It obviously covers even the most unlikely scenarios.
Yep. And would you say in general in choosing an attorney if you're going to be a syndicator or if you're want to invest in a passive investment in a commercial property that mostly is otherwise available only to high net worth and institutional investor, if you want to invest in something like this and you want to pick a sponsor, the best thing you can do is look at their integrity and track record, right?
Absolutely. If you're picking a sponsor and investor, that's probably one of the most important things. Their track record, what experiences they have. You don't want to be the sort of the guinea pig, right? That's going on. So somebody like you, Tom, that's been doing this for many, many years, decades probably, right? Something like that. And I've actually, Tom, I think we talked about it before the show. I actually, based on a lot of these questions that I've had before, I've actually put together a sort of a checklist or a guide that I call the due diligence guide that investors need to think about, a checklist that they should go through before making an investment. And certainly the track record and experience of the sponsor is right up there. And also the quality of their paperwork. I mean, I also get asked by a lot of people to review paperwork who are thinking about making investments, and you'll be shocked as to how much information you can figure out from the paperwork and the quality of that paperwork.
Now, you mean by paperwork, you mean the PPM?
The PPM. I mean, some people don't even do a PPM, and they come up with some ridiculous reasons why they don't need a PPM. And those
good
are
Lord.
Red flags. And
yeah.
So
that alone to me is a flag, right?
Yeah. So I've got that due diligence checklist, Tom. If anybody wants to get a hold of it, they can either email me or your show, and I'm happy to pass that along. Great.
Well, after the break here, we'll get that information to them. But it's I think it's I really love that it has an opportunity for you to for the sponsor to share with everyone all the due diligence they've done and all the information, so they can make a good decision. If it's not the right one for them, then they shouldn't do that. And that's what's nice about these is they get to choose which product and which sponsors they invest their money in, and they can distribute their risk. So our clients just love it. Stay with us. We'll be back with Mauricio Raud in just a moment.
Welcome back to Real Estate Radio Power Investing. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, visit TomWilsonProperties.com. That's TomWilsonProperties.com. Again, your host for today's edition of Real Estate Radio Power Investing, Tom K. Wilson.
Appreciate a lot, folks. I think you got exposed to this concept just through the headlines in recent years about crowdfunding. And crowdfunding is really a popular term today for syndications that have been around for a long, long time. But the one that everybody's been talking about is really a new SEC reg called regulated crowdfunding, right? And that's not everything people thought it was going to be.
No, and I've always been a little bit hesitant about it. I mean, regulated crowdfunding is a completely new exemption, which was billed as, hey, this is a way for you to advertise your deal, but also take non-accrediteds, right, which is kind of the limitations we have with 506B and C. But in reality, the marketing or the advertising isn't really true. You're not allowed to really advertise and point to your website or do collateral. You're basically limited. You have to use a portal, right? You have to use an SEC-sponsored portal, and your advertising is really limited to pointing to that portal. Now, the portal can do all the advertising, but you can't talk too much about your deal. You've just basically got to point them to this portal. So the advertising isn't necessarily there, and you've got the limitations. I mean, you can only raise $1 million in any 12-month period. And really, individuals, if you're going after these non-accredited, you really can't take much of their money. We're talking $2,000 at most, and a lot of them, invest $500 or $1,000. So just imagine you're trying to raise $1 million, and people are investing $50 or $100. It's like,
or imagine
you're going to end up with a lot of people.
And imagine folks who have $100,000 they want to deploy in investing. That's not the way to do it. So our traditional 506B and C syndications like Wilson Investment Properties do are really the way to deploy that. And Mauricio, you've got a nice checklist for how to select a syndicator and that sort of thing, and also some more information about regulated crowdfunding, how can people get hold of that information? Give me your contact, if you will.
Yeah, if they want to just shoot me an email at CS, and that's for client services, so cs@premierlawgroup.net. Again, cs@premierlawgroup.net. And I've got a due diligence checklist that they can look at. And I'd actually forgotten about that article I wrote on regulated crowdfunding, so I'm happy to throw that in there as well. Just kind of goes through that. It's called The Good, the Bad, the Ugly, and it'll kind of outline all the stuff about regulated crowdfunding, which is a larger topic.
Yeah, and that was excellent. That helped a lot of folks take some of the mystery and questions out of that. Wish we had more time. We're about out. I'll just ask you, as we approach a recession in the near future here, which we're bound to, Dr. Doug Duncan says all expansions end. Oh my gosh, they do? So do you think real estate's still a good place to invest, and syndication is a good way to do it?
Absolutely. I mean, I'm a real estate investor. Anything that's outside of Wall Street to me is fair game. Anything that's alternative assets. So real estate, you're always going to need real estate. Everybody needs a roof over their heads and the services. So to me, when money flows out of Wall Street and the stock market, which it will, it's going to flow into these alternative assets that hold their value and have real intrinsic value, like real estate or precious metals and things like that.
Thank you, Mauricio. Thank you for being on the program. Very enlightening information. I know our listeners will enjoy that, and we're so delighted to have you on. We'll have to have you back before too long. Remember to go to TomWilsonProperties.com and sign up for a weekly newsletter. Also, initiate your relationship with us so you can have access to some of our syndication opportunities. And we always love your questions. So come back with us next week. And remember, the only thing that matters is what you do next.